Something very strange is happening. These two lines have been diverging from one another in a historic way for the first time since 2020. This line represents the price of Bitcoin, and this one tracks the largest publicly traded Bitcoin miner. What this tells us is that Bitcoin miners, which have historically outperformed Bitcoin during bull markets because their revenues and profitability are directly tied to Bitcoin's price appreciation, have actually been underperforming Bitcoin itself. And it's not just the largest miner. We're seeing this same divergence across other major mining companies. Now, with Bitcoin showing weakness, it would be easy to assume that these miners are poised for a lot more downside. After all, if they struggled while Bitcoin was strong, it's natural to think they'll weaken further if Bitcoin declines. But we happen to think that some of these miners could actually be setting up for significant upside, despite Bitcoin's weakness. And there's one key catalyst that could provide the fuel for that move. But for that, we need to understand why this divergence emerged in the first place. Over the past few years, Bitcoin's price appreciation and its value proposition as a hedge against currency debasement have accelerated rapidly. This attracted a growing number of mining companies, leading to increased competition within the mining sector. The chart here shows the mining difficulty for Bitcoin, which measures how hard it is to solve the computational puzzles that secure the network and earn new Bitcoin. A higher difficulty means more miners are competing for the same fixed rewards, and that difficulty has been rising aggressively. In just the past year alone, it has doubled, telling us that the cost of mining Bitcoin has significantly risen, since miners now have to do a lot more work to earn the same reward. At the same time, Bitcoin hasn't risen fast enough during this period to offset the surge in mining competition. In fact, the Bitcoin halving in April of 2024 reduced the mining reward from 6.25 Bitcoin to just 3.125, cutting miners' revenue in half overnight. To put this into perspective, when Bitcoin was trading around $70,000 before the halving, a single block reward was worth roughly $437,000 for the miner. Today, even with Bitcoin around $92,000, that same block reward is worth only $287,000 because of the halving. So not only has the cost of mining increased, but even the revenue side has compressed significantly. That's created a major squeeze on miner profitability, as we can see through this line that's stagnated since 2024. This is the core reason why most mining stocks have been underperforming Bitcoin so dramatically. But this could be about to completely change because of a major opportunity that's opening up for these Bitcoin miners. By the way, we've just launched a trading curriculum that is designed to teach you the principles and strategies required to become a highly profitable trader. And we're doing a massive 60% discount on it for Black Friday. We've built this using the same framework that we have been using at Bravo's research to generate multiple double-digit wins, while keeping most of our losses limited to around 5%. This is our biggest deal of the year, where you can get access to our full membership for a fraction of the price. We rarely do deals like this, so make sure to capitalize on it using the link in the description below. Today, the infrastructure built by Bitcoin miners gives them a unique strategic advantage. They control large grid-connected sites, supporting massive computing loads that's needed for mining Bitcoin. In simple terms, they're industrial-scale facilities filled with high-performance machines, drawing immense amounts of power every second of the day. The top 10 publicly listed miners now have a power capacity of more than 14 gigawatts, with the largest one alone accounting for nearly 3 gigawatts. And this power comes from many different energy sources, with over 23% from water, 14% from wind, 8% from nuclear, and 5% from solar. Overall, 50% of Bitcoin mining's energy is sourced from renewable energy, making the power increasingly sustainable. So today, Bitcoin miners already have the energy capacity, computing capabilities, and cooling systems required to support not only Bitcoin mining, but also other high-demand and energy-intensive computing applications. In other words, they're sitting on an infrastructure foundation that can be repurposed for entirely new revenue opportunities beyond just Bitcoin mining itself. On the other side of the equation, the artificial intelligence sector has become one of the fastest growing industries in the world. At the center of this growth are AI data centers, which are massive facilities that power large-scale model training. These sites already require enormous amounts of electricity and computing power to keep pace with rising AI workloads. As this chart shows, total power consumption from AI data centers has surged from roughly 6.5 gigawatts to 23 gigawatts over the past decade. That's nearly a four-fold increase in just 10 years. And this trend is projected to continue growing, reaching 35 gigawatts by 2030 as AI adoption continues to accelerate. But electricity generation in the United States has barely grown since 2005, as we can see through this line. Compare this to China's electricity generation that has surged exponentially, and we can see a major bottleneck here. The US power grid simply isn't expanding fast enough to support the explosive growth in electricity demand coming from AI data centers. So as AI power requirements continue to rise, the industry will need facilities that already have the capacity, computing connections, and energy infrastructure to host that growth. And that's exactly where Bitcoin miners come into the picture. The US power grid simply isn't expanding fast enough to support the explosive growth in electricity demand coming from AI data centers. So as AI power requirements continue to rise, the industry will need facilities that already have the capacity, computing connections, and energy infrastructure to host that growth. And that's exactly where Bitcoin miners come into the picture. Some Bitcoin miners are now beginning to convert part of their existing power infrastructure to support AI and high-performance computing, or HPC. In simple terms, instead of using all their energy purely for Bitcoin mining, a portion is being redirected toward powering AI data centers. For instance, Riot Platforms recently paused a planned Bitcoin mining expansion to dedicate 600 megawatts of capacity toward AI. These hosting contracts are typically multi-year agreements that provide steady, predictable cash flow, unlike Bitcoin mining revenues, which fluctuate with difficulty levels and market prices. By reallocating part of their existing capacity, miners are opening a new, stable line of business without having to rebuild their infrastructure from scratch. And this shift is already showing financial benefits. On average, a well-run Bitcoin mining operation generates about $1.2 million per megawatt per year. But when that same energy is used for AI hosting, instead, it generates around $1.8 million, so 50% more revenue. Of course, if mining difficulty declines or Bitcoin's price rises substantially, that balance can shift again in favor of mining, which is why miners are not completely abandoning Bitcoin, but they are diversifying. With this dual strategy model, miners can continue mining Bitcoin when it's profitable and reallocate capacity toward AI workloads when the mining environment turns less favorable. In essence, Bitcoin miners have evolved into energy-backed computing providers, positioned to benefit from both the crypto and AI sector growth. And the market appears to be recognizing this shift as well. This chart tracks an index of publicly listed Bitcoin miners that have pivoted toward AI over the past few months. As we can see, from 2024 through mid-2025, these miners were also underperforming Bitcoin, but following their AI pivot, the market has been quick to reprice them, sending this index to new all-time highs. In fact, even when Bitcoin showed weakness, these AI-integrated miners continued to rise, reflecting growing investor confidence in their diversified revenue model. Of course, Bitcoin's price still matters, since a portion of their business remains directly tied to Bitcoin's production economics, meaning if Bitcoin were to enter a deep bear market, miner margins would still tighten, putting downward pressure on their price. But as we've outlined in our recent crypto videos, the broader setup for Bitcoin remains constructive. So as more miners adopt this dual strategy model, we believe the market is likely to continue repricing them higher. And once Bitcoin begins to move higher again, it should provide an additional tailwind for the Bitcoin mining sector. Make sure not to miss the big discount that we're doing on our service for Black Friday. You'll get access to our entire trading strategy with all of our buy and sell alerts for each trade. We pride ourselves on being extremely transparent regarding our track record of our winning and losing trades that you can check out on our homepage. We trade stocks, crypto, and commodities. If you're interested, don't miss this deal using the link down below.